Good morning. Welcome back to the War Room. I am Malik. Today is Monday, April 6th. This is our first broadcast of the week, and we are starting it staring directly into the abyss. We stayed completely off the mic on Friday. When a market is executing a textbook algorithmic bleed into a weekend, the absolute best thing a trader can do is turn off their screens, hold their cash, and let the institutions fight it out. If you had the discipline to sit on your hands, you survived. But while you were watching the tape bleed out 1,600 points on Friday, the government dropped a macroeconomic nuclear bomb on the real economy. The 55 rupee fuel hike we warned you about last week is old news. Over the weekend, the state hiked high-speed diesel by an apocalyptic 184 rupees, bringing it to a staggering 520 rupees per liter. They hiked petrol to 458 rupees before the Prime Minister was forced to roll it back slightly to 378 rupees after nationwide protests. The market closed the week at roughly 150,400. We are sitting a mere 400 points above the ultimate psychological trapdoor, the 150,000 floor. Today, we dissect exactly how a 520 rupee diesel barrel destroys the equity tape, and I will show you why a mystery meeting from an industrial supplier this afternoon could be the catalyst that snaps our final lifeline. Let us analyze the pure tape mechanics of Friday's 1,600-point slide. Look directly at the participation. The main board traded over 470 million shares during the session. When a market drops over 1,600 points on nearly 500 million shares of volume, it completely confirms our thesis. Last Wednesday's historic 6,700-point short squeeze was nothing more than an engineered liquidity trap. The institutions pumped the market to 155,000 strictly to find retail buyers to offload their depreciating assets onto. They did this because the smart money already knew the fuel shock was coming. When high-speed diesel hits 520 rupees a liter, the entire national logistics chain fractures. The cost of transporting raw materials to factories and finished goods to markets has just doubled overnight. The cement sector, the textile board, the auto manufacturers, their freight costs are now completely unmanageable. They cannot pass these costs onto a consumer base that is already suffocating from 378 rupee petrol. Q2 and Q3 earnings estimates are not just compressed, they are entirely vaporized. Now, we open the Monday session hovering at 150,400. If the market opens red today and that 150,000 line breaks, technical support vanishes entirely. The cascading margin calls will resume, and we will enter a freefall. The corporate calendar for today, Monday, April 6th, is bringing heavyweights to the table. We are tracking three major pulses across the tech, pharma, and industrial sectors. Mark your screens. 12 p.m., High Noon Laboratories Limited, dropping annual accounts in Lahore. The pharmaceutical sector is traditionally a bunker during macroeconomic crashes because demand is inelastic. But with the diesel shock pushing freight costs to the moon, we need to see exactly how much their production and distribution margins have decayed. 1:30 p.m., Systems Limited, also dropping annual accounts in Lahore right after the midday break. As the domestic economy crashes, IT exports are one of the few avenues for dollar-based revenue that are not completely reliant on local diesel prices. The forward guidance from this tech titan will dictate the momentum for the entire technology board this afternoon. 3:30 p.m., Pakistan Oxygen Limited. This is the explosive hour, meeting in Karachi for matters other than financials. Pakistan Oxygen is a critical supplier to both the industrial manufacturing sector and the national healthcare grid. A mystery, non-financial meeting from a company this systemically important right after an apocalyptic transport shock signals a major operational restructuring. Watch the tape closely as we head into the final hour. Here is your battle plan for Monday. 1. The 150,000 death line. We are hanging at 150,400. The algorithms are going to aggressively test the 150,000 floor at the opening bell as the market prices in the 520 rupee diesel nightmare. If it snaps, do not try to be a hero. Do not step in front of the margin call train. 2. Trade the tech and pharma divergence. If you are forced to trade today, avoid the cyclical kill zone at all costs. Transport-heavy sectors are going to bleed. Watch the institutional footprints around High Noon at 12 p.m. and Systems at 1:30 p.m. 3. Total cash supremacy. We sat out the traps last week and our capital is fully preserved. Do not get impatient. Let the index decide if 150,000 is going to hold or break. Protect your capital. Command the Monday. Disclaimer. StockSense is an educational platform. I am an analyst, not a financial advisor. The market is facing unprecedented geopolitical volatility. Trade at your own risk.